Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the last day of January, the 31st of January 2023. We got a big show coming up for you. We're going to talk about this market. It had one hell of a month. And the stocks that we like, the innovation and growth, did even better. But then we're going to dive into a specific sector within the market, the small cap stocks. Often overlooked, often feared, but that should not be the case. Coming up right now on Making Money. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Once again, thanks for joining me. This is Matt McCall. It is January 31st, 2023. I cannot believe this. I know I'm getting older. And I feel like older people always say this, but boy, time flies. Maybe it's when you're having fun. And I'm having much more fun in the market so far in 2023 than I did in 2022. As you know, markets were down last year. So far this year, we have the S&P up about 4.5% to 5% to wrap out a really, really strong month to kick off the year. We have some of the more innovation growth stocks really outperforming. Even some of the value sectors within the market have done extremely well also. We're going to dive into the market here in a moment. We're also going to take a look at the small cap sector. Often misunderstood, often labeled as risky, even by some of the smartest people in the investment world. We're going to take a dive and take a look at the small caps, how they performed this year, and looking at over the long picture as well. And then from there, take a look at 5 stocks that meet some criteria that I was looking for in the small cap space, all profitable right now, all with very solid looking charts and a really mishmash of different business models that will go across. But those 5 stocks we'll talk about in a minute. But first, I want to take a look at the market and what's going on here today. And as I mentioned, we're having a very strong January. S&P up about 4.5% to 5%, which, it doesn't sound like a lot, but in the grand scheme of things, if you consider that the market averages over the long term around 9% or so, a move of 4.5% to 5% in 1 month is actually a huge move. That's about half of the average gain that the market has over a 12-month span coming in a matter of 31 days. Now let's take a look at the S&P 500. As I mentioned, up 4.5% to 5% so far this year. And this is early morning here in the 31st, open about 40 minutes or so. And we're up another about 0.3%. Off the high that we had 2 days ago because we had a down day to start the week on Monday. But still, it's a very constructive chart. And as you can see on this chart, the blue line is the 200-day moving average, and the red line is a 50-day moving average, both simple moving averages. And what happens many times is they cross. And as you can see, the red's about to cross above the blue, which is meaning the 50-day is going to be above the 200-day for the first time in quite some time. It dropped below it, as you can see in the chart back in March, which led to some downside. A lot of people who use charts look at this as a very important signal that when the 50-day crosses below, it's a sell signal. When it crosses above, it's a buy signal. And really, historically, if you go back on the S&P, it has been a pretty good indicator. And again, as you can see here, is it about to cross over? That could be really a good intermediate term to long-term indicator that the market has more fuel left in this rally. And I'm backing it. I really do. I said months ago that I think, October was most likely to low. I didn't give it 100%. I said most likely to low. And at this point, I don't see anything out there that's going to drive us back down to test that. So keep that in mind when I talk about the small caps we're about to get into. But again, I want to show you this chart of the market because we are above the major moving averages. The one level I'm watching on the S&P 500, I shouldn't say the most important is the 4,100 level. We hit that the first trading day of December of last year, middle of December, and we hit it 2 trading days ago on Friday. We've not broken above that 4,100. If we do, that's a major breakout, in my opinion. It's what you kind of call an ascending triangle, which has higher lows, which is very bullish, but a flat top at that 4,100. You break above there, folks. That is a very strong technical breakout. And if that coincides with the 50-day crossing with the 200-day, we suddenly have a lot of technicals backing us for a run to the next support level around 43.25, which is a nice move. It's another 225 points, which you do amounts a little over 5% on the upside above the 4,100 if it breaks out. So that was really quick and very technical. But remember, I kind of cut my teeth in this market back in the day, 20 some years ago, reading charts. I wrote a book in 2008 about how to read charts called The Swing Trader's Bible. So I've been reading charts for a long time, and I incorporate that into my decision making. And people say, well, why do you use charts for long term? Because many times you can look at a company as great fundamentals. I mean, amazing fundamentals. Everything looks great. It's a value play. It's got some growth to it. But the chart has been going straight down for years. So there's something wrong with the company. The numbers may look great, but there's something wrong with the company. There's something wrong with the stock. So that tends to lead me to avoid companies. If I can put everything in place, and the three pillars I look at are the fundamentals, which of course are the valuations and the growth, the technicals, the chart, if it's a strong looking chart, and then add in the big mega trend that it's in, because we want to use a top-down approach. So we want it to be in a trend that's continuing to grow as well. And when you break that thing even further, if it has market share, gaining market share, has a bit of a moat that people can't take its market share away. They get very technical from there, but those are the three big pillars that I tend to look at. One of the three being the charts. So I always will look at charts before I recommend any stock to our subscribers. So that's kind of where we stand with the market right now. Coming up tomorrow is going to be really the headline of the week. And we have the Fed coming out with their decision on interest rates. It's almost a foregone conclusion that Powell and his cronies at the Fed will raise interest rates 25 basis points. That's going to be a shocker if it goes either way. I don't see that happening. I see 25 basis point hike. And keep in mind, there were several meetings in a row of 75 basis point hikes. It went down to 50 in December. First meeting since December. Now we're going to 25. So they're decelerating the really magnitude of the hikes that they're doing. Next meeting's mid-March. I think we could have 25 there, but it depends on what they say. I don't think we should do another 25 because I think inflation's coming down much faster than the Fed will tell you. And I think the market's actually holding up well. So I don't think there's any need to. However, I think the Fed probably will, but we'll know more after Wednesday. And really the key to Wednesday, folks, is what Powell says afterwards, what the comments are. If the comments lean to them being more hawkish, meaning being more aggressive, the market probably sells off. If he's more dovish, meaning, okay, maybe they only do 25 basis points more and that's it, and they'll pause, the market probably takes off to the upside. So we're gonna analyze that in my daily email, which you could sign up for, as you know, for free. Every day the market's open, we write that. I'm going to break that down on Wednesday, tomorrow, after the bell. That will come out a little after 4 o'clock with my analysis of what happened in the Fed meeting and what that means for stocks in the short term and long term going forward, and some sectors as well that it will be affecting. So now we got that out of the way. Let's take a dive into the area I want to look at today, and that is going to be the small cap stocks. And again, people, when you mention small caps, again, even the smartest people in the investment world tend to automatically think crappy stocks, junk companies, extremely risky, lottery stocks. And that's just an uneducated view of what small cap stocks really are. First of all, every large company, every $1 trillion company was a small company at one point. Apple wasn't just all of a sudden the world leader. Heck, Apple almost went out of business a couple of decades ago. Stock was junk. This guy by the name of Steve Jobs turned it around. You take a look at Amazon. Amazon was selling books. Now look at it. It's an e-retailing behemoth, rules the world. But they were all small companies at one point. Microsoft was started in a garage with 3 nerds. I think it was 3, maybe 4. I think one of them may have left. A bunch of guys sitting around in a garage. I mean, that's the whole story of Silicon Valley, starting these tech companies in garages. Sure, that doesn't happen as much anymore. They've started maybe at incubators or starting at Stanford University, they're large universities that are pushing innovation. But again, the valuation doesn't start out at billions and billions of dollars. And to give you an idea, a definition of a small cap company, publicly traded company, is $2 billion or less. That's not definitive in my opinion, because the companies fluctuate in size all the time, could be well above that, be down below it. A lot of companies moved into the mid-cap range over the last few years, but in the last 18 to 24 months, moved back down to small cap because they've lost a lot of value in their share price. They moved them back down. Their market cap is now back below $2 billion. So I don't view small caps as risky at all. Let's think about some of the stocks that move back down below the $2 billion into small cap territory. Are all of them going to go back to where they were? Absolutely not. Some will go out of business. Probably a large portion of them will go out of business. But an even larger portion will come back and move into mid cap, large cap. And a lot of the small cap companies right now, 10 years from now, will be the leaders, will be the largest companies in the world. I guarantee it. You look at the list of the largest companies in the world every decade going back, they change dramatically. Dramatically. I always tell the story of the Bethlehem Steel Corporation, which was a Dow 30 stock, one of the most powerful companies in the world. A lot of my family worked there. My grandfather, my father, my uncles, my father's cousins. I was born in Bethlehem, Pennsylvania, on the hill overlooking the Bethlehem Steel. And there's no more Bethlehem Steel. Never would have thought that back in the day when they were making everything for the wars. I mean, just pumping out products. You never would have thought that company would go out of business at the time. So let alone not be a leader, but eventually go out of business. That's going to happen to large companies today, and smaller companies will rise and become the next leaders of the market, of the economy. So keep that in mind. Small caps really aren't what people really put them out to be. So the good thing about small caps is they have less coverage. But by that, I mean a lot less analysts will cover them because it's tougher to get information. They're not as well received by the global investment community, so there's not as many people looking for information on it. And number three, a lot of these large firms that cover stocks have investment banking relationships with these companies. Would you rather have an investment banking relationship with Amazon or a small $1 billion company? With Amazon, you're going to make a hell of a lot more money, so you're going to want to cover the heck out of Amazon, know everything about it, versus a little $1 billion company that most people don't care about. But that little coverage, the amount of people that ignore it, creates opportunity. The market is so inefficient when it comes to small cap stocks. So you have opportunity there because there's situations where a company is overlooked. The one caveat to that is companies can be overlooked for years before they really start gaining attention. And at the end of the day, a company is going to grow really for two reasons. Well, the company grows as revenues and profits increase. It's going to increase the value of that company, which means the share price has to go up. But for the share price to go up, we need to be having more buyers than sellers. So as more people get attracted and interested into a company, there's more potential buyers, more buyers than sellers, higher stock price, bigger valuation. So it does take some really investor relations out there, or somebody to kind of get the company in front of investors. And investors like you and I, sure, but bigger investors, mutual funds buying it, hedge funds buying it. That's the big money coming in, and you'll see that in volume in the charts, which is why I use the charts, because you'll see that start coming in little by little as big money comes into a company. And that is typically usually a telltale way to find companies that are really starting to attract big money by looking at the volume in a stock as it moves higher in this situation. So as I mentioned, a lot of stocks have become small caps once again. And I see a lot of bargains out there right now for long-term investors. I also see a lot of overlooked companies that have actually held up pretty well during this craziness we've seen over the last year and a half that are still overlooked, even though they've held up very well. So I went through and I found 5 companies I thought kind of stick out. But before I jump into that, I want to show you a chart here. And this chart shows over the last, year to date, how some of the small cap ETFs have performed versus the S&P 500. Granted, folks, this is 1 month, but as you can see, I broke down a couple different ETFs. And up top here, up 8.8%, is the small cap 600, S&P small cap 600 value ETF. So it's what they consider value stocks, up 8.8% in a month. If we go down a little bit, the 7.29% gain, That's the micro cap. We're not going to talk about those today, but that's even smaller companies, usually less than 1 billion and even smaller. It's usually several $100 billion. The purple line there is a small cap ETF, S&P 600 small cap IJR, 6.82%. And that is going to be all of the S&P small cap 600. Whereas the 8.1% is the value stocks within there. This is all of them. Then we move down and we see 4.94%. That's the growth portion of the S&P 600 small cap. And then down below, that's the S&P 500 SPYs, SPYs 4.75. So all aspects of the small cap have outperformed over the last month, I should say. Remember, I don't care what happens in a month. I'm just showing you a situation of what's going on here, that in the so far 2023, we have had a lot of money coming in small caps, and I think this trend continues. So let's take a look now at how they've done over the last 5 years. As you can see, I have the same exact ETFs in here. The S&P 500 has outperformed pretty much, by a pretty wide margin, about 55% over the last 5 years. Then we go down. Small caps are all up. The thing is, as you can see in the small caps, they are lagging a bit. And if you go back to 2018, you see, the really bright magenta lines, the S&P, that lagged for the first 8 or 9 months. And then when the sell-off happened there, late 2018, remember there was a sell-off in December, some fears, and we bounced back quickly. And then we had, again, the sell-off in 2020 with COVID, and the small caps got hit even harder. And I believe that we're now at a pivot point where the small caps will once again lead. And I think, again, there's lots of opportunity in there. There's obviously ETFs you could play to do this. I would just be very careful when it comes to the ETFs, because they're going to capture the entire group, whether it be the value, the growth, or the overall S&P small cap 600, which of course is 600 stocks. Extremely diversified. Of those 600, a lot of stocks in there I don't want to own. Same thing being said for the value ETF or the growth ETF, or even the micro cap ETF, which I believe has like 1,000 stocks in it. So just give you an idea of some of the top holdings in the value ETF, which is IJS. And some of the top holdings, Meritage, MTH, which is a home builder, Signet Jewelers, SIG, John Bean Technologies. I'm going to talk about that stock in a little bit. So very, very diversified, which is good. But again, you're going to own stocks you don't want to own. And let's take a look here at the value ETF. Here's IJS. Today, about 1.2%. If it closes here, it's going to be the best close going back to August. You can see it's already broken above that November-December high, which the S&P has not as of yet. So this is really showing some really strong relative strength versus the market. And if you take a look at IJR, which is the overall index, very similar to S&P, up against that resistance level right now. If it could break above there, that'd be a really strong breakout. And then the IJT, which is, again, the growth portion, we're kind of breaking that downtrend, but we're kind of right on it. We did just have the 50-day cross above the 200-day, which is really positive. So again, all three really look good to me. If I had to build a portfolio of small caps, I'm going to have a little bit of growth, a little bit of value, and sprinkle in probably some other random ones in there. So I think there's a lot of great opportunity right now. And we're about to take a look at 5 of those, which kind of stuck out at me. Again, nothing here is a buy or sell recommendation. These are stocks that I just want to put on my watch list because as you'll find out why each one made it, but something stuck out, and I think that they could have some upside potential. Again, not saying you run out and buy this today. I've had so many people come at me on Twitter and YouTube saying, you recommend this stock 2 years ago and it's down big. I didn't recommend it. I mentioned it in a podcast. Again, you got to do your own homework here. I'm trying to share ideas and educate you as to why they came onto this list. And sure, there could be some great stocks in here. And maybe I may buy some in the future. I don't own these now, of course. I would disclose that, but no exposure to it, not in our newsletters. But again, just companies here that are meeting criteria that I'm about to show you that I think could be big winners down the road. But again, it may not be the right time to buy them right now. So let's take a look at number 1 here. This company is called Sterling Infrastructure. The symbol is STRL. And Sterling Infrastructure is a $1 billion company. And as it says in the name, infrastructure, it's a construction company. It's broken up into 3 divisions, which are pretty equally weighted. Number 1 is transportation, still the largest right now. They deal with highways, bridges, rail. Second one is building solutions. They do concrete foundations for single-family homes. Both make about 40% of revenue. The third division makes about 20% of revenue. It's called e-infrastructure. They build sites for large companies for data centers, e-commerce distribution centers. So really kind of looking ahead to areas where we're going to need building. We need more data centers. We need more e-commerce distribution centers. And you see them popping up if you ever drive around America on highways, these huge distribution centers, because for Amazon and everything else out there that people order online, you need these distribution centers. And there's only going to be more of those built and only more data centers built. So they're getting into a really nice business. As a matter of fact, that's their highest margin business, which I like as well. Take a look at revenue. Last year, 2021, 1.58 billion. Last year, looking for about 1.92 billion. Up to 2024, about 2.05 billion. So not huge growth on the top line. And I think that's understated, and I'll let you know why in a second. Bottom line earnings per share, 2021, 2.25 per share. This past year, looking for 3.15. By 2024, looking for nearly $4 a share. So we are seeing big bottom line growth, which is great. That means our margins are increasing. And I mentioned an e-infrastructure business, which makes up 20% of revenue right now, was basically 0 years ago. So adding that business has really increased margins, which has increased the bottom line. Valuation-wise, forward PE ratio of 8.7. Obviously, it's extremely cheap. Forward price of sales of 0.51, extremely cheap. Fun fact, there was a pick in Barron's annual roundtable. They do an annual roundtable. I read Barron's every week, and I think you should too. I'm not saying you buy every stock in there, but it's good education. I think there's a lot of great information in Barron's. It's something to do in the weekend when you wake up and have your coffee or tea. But the reason this really hit me is not just because of the fundamentals, and I'll show you the chart here in a second, but this stock really kind of popped up because of the infrastructure aspect of it, the construction aspect. This country is in dire need of upgrading our infrastructure, and it has been for a very long time. But we passed the Infrastructure Act about a few months ago, November 2021, I believe it was. Then money takes years to get in there, but it was over $1 trillion. And companies like this, especially a smaller company like this, if it gets a couple deals along the way, will be a big winner from that bill that got passed. So here's the chart, folks. And this is a chart that's done extremely well. And it's breaking out today. If it closes here, it's closing at a new annual high, and may even be an all-time high. Yeah, it's actually an all-time high. And let me zoom out. I'm going to show you this long-term chart here. This is going to go back. If it closes here, we're breaking above a high that this stock hit back in 2006. Went public back in 01 around buck a share, ran up to 33, back down to $2 a share. Now we're back up to 35. So it's a wild ride in this, but this breakout here, in my opinion, could be the start of another huge rally on the upside for a company that's fairly valued, if not undervalued, sitting in a very, very good situation with spending anticipated on infrastructure going forward. Company number 2 is Sylvan, and the symbol is SLVM. And this is a paper company. And it was funny, I was reading through their documents yesterday and going through some of their presentations. And the only red flag I had is I was reading through a presentation, and some of the stuff that they said, it sounded like it was a pitch deck for Dunder Mifflin. If anybody watches The Office, Dunder Mifflin, based out of Scranton, Pennsylvania, not too far from where I grew up. So it kind of gave me a laugh to even consider investing in a paper company, a $2 billion paper company. But after looking at numbers and thinking about it, I actually see there's some big upside to it. And the name Sylvamo, according to the company, is formed by two Spanish words, which is Silva, which means forest, and amo, which means love. So that's where that comes from, the love of forest. They have paper mills here in the U.S., Brazil, as well, 3 down there, and then a smaller one over in France. But they make everything, for all different types of uncoated fresh sheet for paper products. They all do copy and printer paper, commercial printing papers, converting papers, specialty papers. I mean, they're basically in the paper business. Revenue 2021 to 3.5 million, last year for 3.7, 2024 3.9. So again, so not huge growth in the upside, but you don't expect that from a paper company. But again, I mentioned it's only a $2 billion company. On the bottom line, though, look at this. 2021, $6.94 a share. Last year, looking for $8.13. By 2024, looking for $9.56 a share. So that gives it a forward PE ratio, just looking at 12 months, of 4.8, a price of sales of 0.52, pays a 2.16% dividend. And let's take a look at this company on the chart and kind of show you why else it kind of popped out at me here. This is one heck of a good looking chart, folks. It just started trading back in September of last year. And as you can, or sorry, September of 2021, went to a new high in December, pulled back. This is an uptrend. Higher lows, I love this. Higher highs, going down close to support level here around 44. Nice looking chart. And this is the type of stock that, a lot of people got burned with growth and innovation last year. And yeah, I was one of them. And I still believe in growth and innovation. It's not like I'm moving away from that. That's still my bread and butter. I still think will be the best performers in the next 10 years. That being said, a lot of investors want to diversify their portfolio. I'm 100% behind that. A company like this will help you diversify your portfolio. As I mentioned, I'm nearly a 2.2% dividend yield, which isn't great, but it's some cash coming in, a nice looking chart, and it's in paper. Paper. It's not the next artificial intelligence company. It's not the next autonomous driving company. It's not the next space exploration company. It's paper. And we're not going away. We still use a lot of paper. I still print stuff out all the time. So this is a company I think you want to add to it. It's a small cap flying under the radar 100%. The third one is Avid Technology, symbol AVID. It's about a $1.3 billion company. This company, they develop and sell software and hardware for digital media production and management. Somebody once called this company the Excel of video and music. And what I mean by video and music, this company's software and hardware is used to create music, create videos. Avid actually has won 18 Emmys, a Grammy, and 2 Oscars for its technical contribution to the arts. So it's used for movies, all types of stuff. As I mentioned, music. They have a bunch of different suites. They have some for video editing. They have some for newsroom management. So news stations use it as well. They have on-air programming tools for that. They have some for digital storage. So it's really an interesting company, again, it's flying under the radar in an area where we're producing more content. And that's what really got me. People are producing more content, which I like. And Avid, again, because you've probably never heard of it, you think, well, what the hell they do? Diversified as far as revenue, about half the revenue is in the U.S. The rest is global, which is good. Again, nice diversification within a smaller company of this size. But the big highlight that I saw in this company, going through the pitch decks and the presentations, was the fact that they're moving to what's called a SaaS model, SaaS. That's software as a service. So instead of being more old school Microsoft, here's your CD-ROM, here's your software, here's your hardware, you're good until you have to buy more from us. Software as a service is kind of what you do now with Windows. You just pay for the year and you can use it on a computer. There's nothing, it's just all in the cloud. And they're moving to that business model. And we've seen other companies, when they've moved to that business model, how well stocks have done. Adobe did it years ago and the stock went bananas. And you're starting to see the stock really take off. And I think you're going to see margins increase dramatically. Now, the fundamentals for this company, in 21, they did 409 million. This year, looking for 416. So not a big gain at all. But by 2024, looking for 506 million. I think a lot of that has to do with the movement towards that SaaS model. Earnings per share, 2021, $1.25. Last year, $1.44. But then jumping to $2.09 are the estimates for 2024. Again, due to that SaaS model. Forward PE before related SaaS model even takes any effect on it. 14.5, price of sales 2.6. And because most large production companies use this, and it's used by people training to be in that business, it has a moat around it. And what I mean by that is think of a castle and the moat around it. It's very difficult for somebody to come in, a new company, and convince you to re-up your software, completely throw it out the window, and start with a new software. Sure, they can undercut in price, but there's a quality there. And how much will it cost to train your employees and yourself to do that? See, a lot of times it's very difficult. Microsoft's a great example. If there's a new Excel out there, sure, there's Google Numbers, whatever it's called. I can't stand it. But most people still use Microsoft Office. It's just tough to do that. I'm not saying this is Microsoft. It's not a $1 trillion company. It's a $1.3 billion company. But again, they have quite the niche business. And here's a chart, folks. Now, as you can see, this is very similar to some of the indices I showed you, where we came up to $30 in May, July, June, once again, November. We actually broke through it recently. So it broke through that resistance level at 30, give or take 30. That is really important. Looks like this stock is set to soar. This is a company that, again, Probably isn't going to make you the most popular guy at the bar talking about stocks. But again, this is a company that could potentially make you the guy that can buy the drinks at the bar for everybody else. The next one is a small company, $246 million, Thorne HeallthTech, symbol THRN. This is basically, it's a wellness and nutraceutical products company, and they have their brands. One brand is Thorne, THORNE, and the other is Longevity. Instead of longevity, Longevity. And they are a supplement manufacturer, but they also bring in some AI and some other stuff into it. They just recently got approval for one of their gut health tests in June of 2022. It's a health kit. So we're seeing a lot of people move to more longevity thinking, more health conscious. And according to Grandview Research, which does research, their 2020 report, they said a global market for dietary supplements was about 140 billion in 2020. By 2028, they expect it to be 271 billion. That's big growth. Obviously, that's nearly 100% growth in that 7 or 8 year time frame. So there is big market growth behind this. And when I look at the numbers, they're pretty impressive. But just to give you an idea of kind of some of the collaborations they have, they collaborate with the Mayo Clinic on health and wellness research and content. It's the only supplement manufacturer that does that. They have more than 5 million customers right now. We're 46,000 healthcare professionals that they collaborate with, thousands of professional athletes, over 100 professional sports teams and U.S. national teams that use their products as well. So they are definitely out there, and you may have heard of them. You may have seen them in your social media pop up as well. I have. So revenue in 2021 was 185 million. Last year, looking for 233. By 2025, looking for 445 million. So big growth on top line. Again, only a $246 million market cap today. And it's profitable. 2021, it made 21 cents a share. 2022, looking for 35. By 2023, which is this year, which is, we don't have estimates out past that, 86 cents a share. Forward P ratio of 7.4. Forward price to sales of 0.8. Let me show you the chart here, though, because you might say, what the hell's going on here with this chart? You take a look at a chart here of Thorne, not nearly as nice as the others. They went public here back in September of 2021, ran up, and then it's just been a downturn. A lot of these companies that went public back then have really gotten beaten up, and not all are going to make it. Maybe half won't make it. I think Thorne will be a survivor because it is a profitable company. It is growing top line and bottom line at very high double digits. It built a base at 350. We're starting to see it break out. Very, very, very aggressive play, folks. But again, it's one that I think is flying under the radar, that is beaten down. That could be a potential play. The last one I want to talk about, it's a little bit bigger than that 2 billion, but it was in the top 5 of the iShares value ETF. That's why I want to talk about it. It's a company I've followed for a very long time. It's called John Bean Technologies, not Beam as in the whiskey, Bean, like BEAN. John Bean Technologies, symbol JBT. It was spun off from MFC Technologies way back in August 2008. Over half their sales come from the U.S., and they have 2 different segments they operate in. One is what they call food tech, and this provides really customized and turnkey solutions for food and beveraging industry, whether it be a protein processing plant, a packaging solutions. It could be ready-to-eat solutions, fruit extracting, juice extracting from fruits. So they'll come in and basically back these food processors. The other division is the HeallthTech, and they work in the airline industry with passenger airlines, air freight, defense contractors. They also include the gate equipment, the gate that comes out and picks you up when you land and it hooks onto your plane and you walk through it. They're big into that as well. So that's really 2 very different divisions, which is nice. It does give it diversification. John Bean is a $3.5 billion company, 3.4, let's call it, $billion company. So still a small company. I mean, don't get me wrong, still small. But if you take a look at the financials, it looks good to me. I mean, 2021, 1.86 billion in sales. 2022, we're looking for 2.16. That's about 2.45 next year. Then we look at the bottom line, folks. Made $4.03 a share in 2021. 2022, looking for $4.68, up to $6.26 in 2024. Forward P ratio of 17, forward price of sales 1.4. Not the nicest looking chart, but what I like here is it consolidated. Anytime there's a bear market or downturn, you have this chart pattern, which we've had since November of last year through January or through December of last year on JBT. So you see that come all the way down, right? It comes all the way down over about 14 months. You build a base. It's building a base in September. Then you have to break above the upper end of that base. That's about $100 a share. We're at 107.92 right now. On Friday, we closed at the best level since last August. This is a good sign. Big volume coming into it. You can see some big green spikes on the bottom of the chart. Because when stocks turn around, you don't want to try and pick the bottom, but you look for a base and a breakout. Because by the time you get was back up here, you missed a huge gain. By the time JBT gets back to its old highs, from here, it's up about 70%. That's when the big move happens. Again, I'm not telling you to try and cherry pick the bottoms or catch a falling knife, as they say, but there are opportunities in charts to see when the base is built. And you really kind of go from there. And you have to realize that you're never going to pick the exact bottom. Look for the sweet spot. And for JBT, it looks like that sweet spot's starting to form right now. Very similar to the last chart we looked at, Thorne. Maybe it's starting to break out here as well. We saw something similar with Avid breaking out too of its base. So those are 5 companies out there that I think you want to add to the watch list. Again, nothing's a buy or sell recommendation, but they all kind of touch a very different aspect of the global economy, all touching areas that I think can continue to grow and have good valuations and good stories behind them. So again, do not be afraid of small caps. That is where the greatest opportunity in the market lies. I listened to a audiobook the other day and a chapter on the Ariel funds. I was the first Black-led large mutual fund out there based out of Chicago. The gentleman started it in his 20s out of Princeton, worked for a couple of years and started it. Great. I'll name the book next time I do a show next Tuesday. But he talked about how he kind of started his business and it was looking for small cap. He realized early on, as I did, that that's where the opportunities lie. That doesn't mean there's not opportunities in mid cap or large cap. There are 100% are. But the small cap is still so overlooked. Not enough smart people in there that if you do your due diligence, do your work, you're going to come out with some huge winners, folks, over time. But again, the caveat is it takes time. You have to have patience in this market. Well, again, if you have any questions, comments, please put them below. Don't forget to like and share the video. If you're listening on a podcast in your car, thank you. Keep your eyes on the road. But again, we love your feedback, good or bad. Please give it to us. And next Thursday, our next show coming up, I should say this Thursday, we have Matt Hogan, who's an executive over at Bitwise. So we haven't talked about the cryptos in a while. We have Bitcoin breaking at above 23,000. What's going on? Has a bottom informed in crypto? And what's the next move for Bitcoin going forward? We're going to ask Matt Hogan that coming up on Thursday's show. Once again, thanks for watching. That was Making Money, and I'm Matt McCall.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.